Hello friends, welcome to CS Aspirant Vibes. Today we will discuss about balance of payment. This is also known as balance of international payment. It's international because we are dealing with international payment, not with any kind of domestic payment, right? So the balance of payment is a statement of all transactions made between entities in one country and the rest of the world over a defined period of time, such as a quarter or a year. That means if India is doing certain kind of transaction with any country of the world, so we will include all the transactions over here. That should be for a specific period of time. That may be a quarter or a year, right? So the balance of payment is the difference between the inflow and outflow of foreign exchange. That means there will be certain kind of inflow of foreign exchange and certain kind of outflow of foreign exchange. When we will get the difference, that figure is known as balance of payment. For the time being, just understand this much. I'll make you clear later, right? So this one is balance of trade. Balance of trade is the difference between the value of export and value of import. As we are dealing with trade, so we are talking about the export and import. Here, when we are exporting something, in return of that, we are supposed to receive some foreign exchange. That means it will replenish our forex reserve, right? So it's a good thing. Now, when you are importing something, that means we need to pay something. Means we need to pay some foreign exchange. So it will deplete our forex reserve. So export is a good thing, but import, as India is an import dependent country, so we have to import some item, right? When we are getting the difference between the value of export and value of import, we call it balance of trade. Now I'll just make it clear through this picture. Just look at this. This is balance of payment. It is two component. One is current account. Another one is capital account. Under current account, we have visibles or goods. Another one is invisible. It is consisting of services, income and transfer. So we can remember it like SIT, services, income and transfer. Now come to this part. That visible or goods means a country is exporting some goods and also importing some goods. For example, in case of India, heavily we are dependent on import of crude oil, gold and chemical and some other items. And we are exporting like petroleum, some petroleum product, and also here that gems and jewelry and some electronic items, something like that. So here, but we have deficit over here because we are importing more than our export. So we have deficit over here. Now come to this part, invisible part. First one is services. India has core competence and expertise in this area. So we are exporting IT service, tourism, health, education, and some other services also. And also India is importing these kind of services. For example, India is exporting IT service, India is exporting tourism. So the foreign tourists, they come to India and they are visiting certain tourism, means certain tourist places. That means we are exporting that service, right? So the health, when we have better health infrastructure and some foreign people, they are coming to India for the treatment of their illness, that means we are exporting that health service. And also when the foreign student, they are coming to India to pursue their education, we call that we are exporting education. So here, as we have core competence, as I said already, so we have surplus over here. Now come to this part, income. When some foreigners, they are investing in India, that means under capital account, in FDI, foreign direct investment, and also foreign institutional investment. So here some foreign entities, they are investing in India. So in return of that, we need to pay some interest, dividend and profit. Likewise, when the Indians, they are investing outside, they are supposed to get certain kind of interest, dividend and profit. Here in this category, under income, we have deficit because more foreigner, they are investing in India, rather we have less Indians, those who are investing outside. So as they are investing less, in some less number of entities, they are investing outside, so we are getting less income. Here, as they are investing more, so they are getting more income. As we are giving more than we are receiving, so here we have deficit, right? The third one is transfer. It is consisting of remittances, donation and gift. The remittances means the Indian diaspora, those who are living outside. So they are sending money to their family members, those who are staying in India. So we call it remittance. So in 2019, according to the estimation of the United Nations, we have 17.5 million Indian diaspora. they are staying abroad. So this is the estimation of United Nations. And also in 2020 we had an estimation that it says that 83 billion is the remittance inflow for India in 2020. So that means we are receiving more, right? So India in remittance receiving, and also in Indian means in diaspora, India is at the top position. So and also we are receiving certain kind of donation and gift, and also we are giving certain kind of donation and gift. So when we are combining all these, so we are in surplus, right? So when we combine this invisible part, means services, income and transfer, in total we have surplus here, and in this category we have deficit, right? But when we'll combine these two to get this current account, in general we have deficit, because the surplus in invisible part is insufficient to compensate for the deficit in visible part, right? So we call it current account deficit or CAD, right? Now come to this part. This one is capital account. It is consisting of investment, loan and banking capital. Investment means when the foreigners they are investing, means the foreign entities or foreigners they are investing under foreign direct investment or foreign institutional investment, we call it investment, right? That comes under capital account. Here we have surplus, means more foreigners they are investing in India rather the Indians they are investing outside, right? So in this case, here we are counting loan. So the government also taking loan, and some external commercial borrowing is done by some business entities. So this in this case we are combining these two, and also here we have surplus, right? Here in banking capital, the NRI deposits we are considering here. So this will come under the capital account. Here also we have surplus, and when we combine these three, we will have surplus definitely, because in all the three heads we have surplus. So capital account is in surplus and the current account is in deficit. So in general, so the surplus in capital account is used to compensate the deficit in current account, right? But when in certain cases it is insufficient, the surplus in capital account is insufficient to compensate for the deficit in current account. So in that case, we will be in a crisis position. There will be balance of payment deficit, and if it will continue for some year, we will call it balance of payment crisis. As we faced in 1991, right? For that reason, we had to accept that economic reform. We call it LPG reform, that is liberalization, privatization and globalization, right? So in that point of time, India's import cover was only for 14 days. That means it was only for 2 weeks. But now India's import cover is uh, around for 20 months, right? So we have increased our forex reserve tremendously, uh, because of some reforms and because of some structural changes, right? So now understand this one, that BOP crisis, as I said earlier, that when capital account surplus is insufficient to compensate current account deficit, we call it BOP crisis or balance of payment crisis, right? So in general, we have surplus in capital account, but in general, we have deficit in current account, right? Now understand this one, balance of trade. When we'll include these two, means goods and services. Trade means generally we are dealing with goods and services. Here balance of trade is net difference between import and export. That means we are considering both goods and services. When we are getting the net difference, we call it balance of trade, right? In general, we have deficit in goods, as I said here, that we have deficit because we are import dependent country, and we have to pay uh, a huge amount for this, for the import of this crude oil and some other important element, essential element. Here in services we have surplus, but when we combine these two, means deficit in goods and surplus in services, we have deficit, right? So as I said earlier, that when we combine these two, we have deficit, and also when we combine this visible and invisible part, here also we have deficit. That means we are importing much more than we are exporting, right? Now I say that balance of trade is negative, that means we are importing more than our export. That means we are in trade deficit, And the next one is when I say that balance of trade is positive, that means we are exporting more than our import. Means we are exporting more, we are receiving more foreign exchange than we are importing less, and we are paying less foreign exchange, right? So we have trade surplus. Now, if you understood all these, that what is balance of trade, what is trade deficit, what is trade surplus, and also what is capital account surplus, what is current account deficit, what is balance of payment, what is visible, what is invisible. If you understood all this, just answer one question, that which of the following doesn't form part of current account under balance of payment? Under balance of payment, which one of the following is not forming a part of the current account? Just understand, export and import of goods, export and import of goods, this is a part of current account. This one is export and import of services, export and import of services, this is a part of current account, right? Income receipt and payment, just look at this, income receipt and payment, this is a part of invisible, and invisible is a part of current account, right? The last one is capital receipt and payment. So just look at this, capital receipt and payment, this is coming under this capital account, right? So this one, last one will be the answer, that not form a part of the current account. So this one is your answer, right? I hope you understood the topic. I'll try to put some more questions in Telegram group so that you will be more thorough about it, and maybe in your exam you will get some kind of same kind of question, so you will not leave that question, right? So this much is for today. Thank you.